Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 201. Today we're going to talk about how sometimes investing in IPOs can be a very risky venture, and I'll walk you through why in some of the IPOs you need to be very cautious. But first, a look at the markets. Actually, markets have been reasonably, I would say, choppy, and during the day also there were several legs down and then up and then down and then up. Ultimately, Nifty closing only 0.1% lower, but the banking is where the selling has been coming through. There was also large bulk deal in Kotak, which caused a initial flurry down on that stock, but largely the selling through the foreigners have been coming in the banking and finance space. Metals, on the other hand, have been rallying, metals and commodities. Pharma and IT also have been quite decent. FMCG has not really performed, and energy stocks and infra stocks are also in the green. So there is a polarization within the market towards metal, IT, commodity, pharma, energy, and money sort of rotating out of banking, autos, and consumption stocks and FMCG. Some sort of a cyclical behavior is there, and of course, it is also March ending, so a lot of sort of window dressing of the books, etc., also may be happening. So it's difficult to find trends in the last week of March. Some redemption pressures may be there for some funds, and there may be fresh buying or allocation for the end of the year as well. In terms of the broader market, however, the small caps and mid caps both were reasonably robust, up about 0.4% each, and Nifty Next 50 was up about 0.19%. Rest CNX 500 was totally flat, CNX 200 was totally flat, and Nifty also. Within the weekend investing universe, almost all the strategies were up between 0.25% to 1%. So reasonably positive day for all the strategies, and most of them have now removed any negative sort of performance within the last 1 month. And for the financial year that is about to close in a few days, MIMT all cap, MI 25, MI EverGreen, MI 50, and MI ATH, along with MI 20, looking very good compared to their respective benchmarks. In terms of the big movers today, Zee Entertainment up 17% after Invesco announced that they are not going to pursue the matter that they had with the Zee board. Sequent Scientific up 13%. Dhani Services took a U-turn today, plus 10%. Future Retail again plus 10%, and Dish TV following the Zee move was up 9%. L&T Finance, however, dropped dramatically at minus 8% after a phenomenal rise in the last couple of days. Responsive Industries, Infibeam down 5%, Rail Vikas and Welspun down about 3%. These were the big movers up and down on the CNX 500. So as I was mentioning about the IPOs, this is the usual chain of sort of food chain of fundraising that happens. Is that promoters set up a company, maybe a startup, and then they need funds for growth, so they approach angel funds or seed investors, angel investors, who put in the initial investment along with the promoters. And then once the proof of concept and the scalability of the project is deemed to be robust, then the next stage of investors like venture capitalists, they will come in and take a chunk of the company and invest more into the company. Now all these folks are investing so that they may be able to exit at some point, right? They may not be holders forever. So primarily the aim is to buy cheap and sell at high, just like any other value investor's aim is. And typically what happens is that the angel seed and venture capitalists or promoters also are able to offload to the public in an IPO. So very rarely you will find that IPOs are priced attractively so that there is something left on the table for the retail investor. A lot of pre-IPO deals also happen. So pre-IPO placements happen where some private equity guys or some other large investors may also participate, and then they with some small lock-in they are also able to offload later on. So I'm not saying all investors are looking to offload at the time of IPO, but this has become a reasonably popular strategy to flip, to buy before IPO and to sell immediately on IPO or as soon as the lock-in period is done. And this is exactly what has happened in the recent cases of these new age IPOs, whether it is Nykaa, whether it is CarTrade, Zomato, Paytm. And you can see the chart in the last 3, 4, 5 months, all of them are down 30 to 65%. And basically, the people who have bought at the IPO price are the major losers in this, or those who have been holding these stocks for long. They may turn around at some point and they may actually make money, you never know. But this short term game of flipping is very rampant, and although the regulator wants to somehow bring the issues at a fair price, but there is no real mechanism to do that. And as you would have noticed that in bull markets there is a beeline for IPOs, because promoters and the investors who want to offload know that in a bull market people will be mindlessly applying in the IPOs and will buy in the underlying strength of the market and hoping that everything will go up. So this is something to remain cautious about, because you are at the bottom of that food chain and everybody else is there to eat you actually. So you have to be very, very careful. You have to know your stock, your study, and only then, in case you can even combine it with some technical study, or you allow it to the stock to base out and then you buy it, that will be a much more prudent strategy according to me. But just a note of caution on this. Another insight today was the opening of the Moscow Stock Exchange. So they have curbed short selling and very limited stocks are trading, but it jumped 15% on that. So the thought on this is that although a lot of people put a lot of money into the markets and a huge chunk of their savings into the market, there is still uncertainty about it, right? So if this kind of an event happens in your situation and the markets are closed for month or months together, it can be a bit scary situation. So the idea is not to put all your eggs in the stock market. Have a diversified asset allocation, so that even if one window is closing for some time, you have liquidity through another window, and life has to go on. So this is the kind of message one can draw from it. I mean, if the currency has been cracking in ruble terms, USD ruble went from 77 to 140, now it is back to 97. But with that kind of a currency crash and with this kind of a stock market crash that they saw, the only thing that saved the prudent Russian investor if they were holding gold. So you must allocate to the hedge to your portfolio in terms of gold and in terms of asset allocation to your overall portfolio. On topic of gold, this 22-year gold returns have been put in a table of various currencies. So this is USD, Euro, Pound, Australian dollar, Canadian dollar, Chinese yuan, Japanese yen, Swiss franc and INR. and for each year the returns are presented here. In the last 22 years, the average returns in most currencies is near 10%, and in INR it is at plus 12% average. While one can scoff at gold and gold returns like a lot of equity investors do, with the kind of instruments that are available now, especially in India, of the nature of SGB, you are getting this 12% capital gains tax free and a 2.5% taxable interest on top of it, which is almost like 13.75 post-tax returns for most people. If in the last 20 years you have got 13.75% post-tax returns in any instrument, I would think that should form a significant part of your portfolio. 13.75% post-tax returns in Indian rupees is not a small change. Nifty has not been able to do that, by the way. So, allocation to a asset class which also provides a hedge to your equity holding and which is giving you this kind of a return is a no-brainer actually. So this is something that I wanted to point out also, and I keep pushing people towards gold because there is a resistance to buy gold, and I've shown in n number of examples how gold actually helps your overall portfolio. So I'm hoping that one by one most people will be able to appreciate these concerns about the monetary system, etc. Another insight from Incrementum Bloomberg is that how do markets perform when there is stagflationary environment? There's a lot of talk by economists that this decade is likely to be high inflation, low growth period. So, which is basically stagflation. So you are stagnating while you are inflating. So the term of stagflation comes from there. And in the past, whether it was the 1960s, whether it was mid 70s, late 70s, early 80s, whenever the world had a inkling of stagflation periods, these were the returns from each class of assets, whether it was US dollar, whether it was S&P 500, metals, industrial commodities, livestock, gold and silver, oil, and US treasuries. And you can see that the average real return for S&P 500 was 7%. In metals it was negative, industrial commodities were negative, gold was plus to 25%, silver was plus 13%, and oil was hugely high at plus 64%. So while it's difficult to invest in oil, you can look for some ETFs in the US, for instance, but right now most commentary is that oil is at a temporary high. What happens if this is not a temporary high, but it is actually making a strategic decadal shift towards a higher range? If that happens, then all bets are off for cheaper oil for India, for instance. So this is real concern for many years coming together, and the war, Ukraine-Russia war, may just be the trigger for all this to happen. We don't really know when it stops and whether all these prices come back or not. So these are some of the insights for a stagflationary environment. Please do study this chart and see how you can apply this to your investing. So this is all I had for today. Thank you so much for watching and sharing this video with your friends and family, and I will see you tomorrow in another video. Thank you so much. Bye bye.